We spoke about forward, futures, which are the three main guys speaking about. We're talking about this one. And then we're talking about valuing them, their pricing and their valuation. So we said for forwards, at the initial stage, there is no commitment. There is no money that anybody is putting down for the contract. It's just a general, just an agreement until the maturity date when it is settled. When we spoke about futures, and we said, okay, futures is different because now there's a clearing house. Because there's a clearing house, how will you come out to market, initial market, maintenance market, we spoke about that. We said because of that, for futures, at the beginning of futures, you have to put down some money, like forward. You have to put down an initial margin. We'll talk about the maintenance margin, which we said is like the minimum balance. We'll move to options. And for options, we spoke about the two guys in option, call and put. And we said the call option is an option to buy, the put option is an option to sell. And we said, okay, for this to happen, somebody also has to put down the premium at the beginning. The premium is, like we said, to ensure that even if you want to back out of it, the other counterpart has not lost completely. At least it has that premium you have put down. So we spoke about the call and the put options. And we said, okay, yes, you have to put down some money first. Then we now went to valuing these options. And we said, okay, we look at the call option. What does the call option really entail? So we said the call option is an option to buy. So we said there is an X. So this X is, it's the exercise price. I want to also call it our agreed price. So just think of this X as the price we have agreed before that we are going to carry out the transaction. Then we have the S. So the S is the underlying price, which we will call today's price. So always think of it like this. There is an agreed price and there is today's price. Now, for a call option, I have agreed to buy something. So if I have agreed to buy something and I discover that the agreed price is greater than today's price, what am I doing? When I see X is greater than S, I will not buy. Because I can go to the market and buy at today's price and then to this for the call. For a put, I'm selling. So if I'm going to sell something to you at a lower price and I see that in the market the price is higher, what do I do? So if this agreed price is greater than the actual price of the market, I will exercise. Easy. So just always look at it like this. Right. So we said, okay, in valuing call and put, this is not the only thing we look at. So for the call, now we said, if the exercise price is greater than the underlying price, don't exercise. Meaning the call has no value for you, zero value. But if we now say S is greater than X, right? It means in this case, you will exercise. And then the difference between X minus X is your benefit, profit. But we have to take out that premium. The profit minus the premium you have paid from the beginning.
It's not true.
Yes. Good afternoon. Yeah, so I was just trying to run through what we have done basically so far. So of course, we said I'm trying to bring a different dimension to it so that you see for the X, which is the exercise price, we take it as an agreed price. That's the price we have agreed to do a transaction before. The other S, you take it, which is the underlying price, you take it as today's price. So I now said for a call, the call is the right to buy. Of course, I want to buy something, so I would like to buy at a cheaper price. Now, if the price I've agreed with you before is greater than the price this product is being sold in the market, when we say today's price or market price, the price is being sold in the market, what am I going to do? I'm going to say no, I'm not going to exercise that option we have. I'll prefer to go to the market and buy it at the market price. That's what I said. And then the opposite works for the put option. I want to sell. I've agreed to sell to you at a price, but I discovered that price I've agreed to sell to you is lower than what goes in the market today at today's rate. So what that means is that I'm going to exercise because I discovered that I can sell to you at a higher price compared to what's happening in the market. Then we now said we brought up an issue called premium because this option is not free. Whether you exercise or you don't exercise, there's a cost to it. You that you are buying the option, there's a cost to it to you. So we said, okay, fine. That cost, of course, you have to take it out from your profit to get your balance. It's okay. On a net basis, have I gained or have I lost? That's what you look at. Okay, so I just wanted to do that brief rundown and then we'll continue. So pricing and valuation of forward contracts and for an underlying with varying maturities. So this one, I just want to reiterate it. We did this last week. I just want to bring back the formula to your mind. So remember we spoke about arbitrage opportunity. And we said the market does not want arbitrage to exist. And even if arbitrage does, it tries to close the gap immediately. So from the beginning, we also spoke about forward contract. So we said the forward contract is the spot times 1 plus the risk-free rate. What does that mean? That means if I have I will have a spot price today and I want to derive a forward price in the next 2 years, I can calculate it today what the forward price should be using this formula, which is what is the price today, spot rate, multiplied by 1 plus the risk-free rate, raised to power the number of years. So if it's 2 years, the T on top will be 2. If it's 3 years, it will be 3. So, and then we said at initiation, the forward contract value is 0. We spoke about this because we said there is nothing that is happening. We have just agreed to do something. We have not transferred anything between the two of us. And we said, okay, even during the lifetime as well, it's the same thing because you are not changing, unlike the futures contract where we said there is a mark to market on a daily basis. So for this forward, there is no mark to market. So the only time we will come back together is at the end of the contract, which is 3 months, 6 months, depending. So during the life of the contract and the initiation of the contract, everything is the same. What changes is at the end of the contract. So we spoke about that. Let me just run through. So we now spoke about cost and benefits. If you remember, we said if we are looking at the asset itself, remember derivative is deriving its value from an asset. Now if you look at that asset, if the asset is a physical commodity, there is a cost to holding that asset, and there is a benefit to holding the asset. So if it is a share, if I have a share with me, a share price, shares of an organization, at the end of the day, they will pay me dividend from time to time. That dividend is a benefit to me. So if I'm going to value this derivative at the end of the day, I need to take out that benefit. I give you the example of car and other things last week. I need to deduct that benefit. Then I said in terms of cost, if I've spent, for example, I have an asset, let's say an animal or a goat. I bought a goat. I have to keep the goat somewhere. I have to feed the goat. Let's say I have to employ a security guard to take care of the goat. At the end of the day, if I'm going to sell that goat, if I'm going to value that goat, I'm going to add back all these costs I've spent over the life of it. So that's what this formula is saying. Same formula as before, but in this case, if there are costs, you add it. If there are benefits, you deduct it. So this is to give us a situation where there is no arbitrage relationship. So if I take the spot price today and I add the cost, I deduct the benefit, and I deduct the future price and the risk period, I should get the same value. So this is the value of a risk, no arbitrage transaction. I mentioned this last week, I'm just taking it again. Then we spoke about the forward rate and how you can identify it, the notation. So we said you see F and then you see two numbers under it. What do the two numbers mean? So we said the first number, so the notation for forward rate must identify both the length of the loan and how far in the future the money will be loaned. So it's possible that you are here today, but the transaction is going to start 1 year from now and it's going to last for 2 years. So this forward rate has to be able to capture that, so that anybody that sees this notation will know, okay, yes, this is what it means. Right? So an example is, so for F21, this is a 1 year loan to be made 2 years from now. So the first number you have is the period, which is between today that I'm entering this contract and when this contract is going to start. So if I say this contract is going to start in 1 year time, so I will have F1. If it's going to start in 2 years time, it will be F2. Then the second number is the period is going to last. So when you see F21, it means that this is a 2 year contract. Sorry, it's starting 2 years from now, but it's a 1 year contract. If you see F32, it is starting 3 years from now, but it's a 2 year contract. So what you'll be given sometimes in the exam is to say, calculate the difference. So they can give you a 3 year contract starting 3 years from now, but lasts for 2 years. And a contract starting 3 years from now lasts for 1 year. And they tell you to calculate the difference between the two. So of course, the two contracts should start from at the same time, but the period it will last is where the issue is, so that you have to calculate the variance in between. Okay? So I'm just trying to run through what it is we spoke about last week. So we did this calculation as well of the implied forward rates, where we said, so consider 2 zero coupon bonds, one that matures in 2 years and one that matures in 3 years. Calculate the implied 1 year forward rate 2 years from now. So they've told you that the first one matures in 2 years and the second one matures in 3 years, but they both start 2 years from now. So they say calculate the 1 year rate. So you are calculating the difference between the second year and the third year. That's basically that. So of course you calculate the, so this is the SO multiplied by 1 plus RF raised to power T. So the spot rate is 100. 100 multiplied by 1 plus RF. RF is 3% in this question. Raised to power 3, that's for the 3 years. Then for the 2 years, it's raised to power 2, and it's 2%. So once you calculate the 2, for you to get that 1 year in between, the forward rate in between, you now do the 3 year answer invoice divided by the 2 years minus 1. Basically. Okay? So that's that. And we move to the business of today. Okay, so We've spoken about forward contracts. Now it's now to go to the futures contract. And we've spoken about this futures contract that is different from the forward because here you have a daily mark to market. So every day they come together. If you remember the examples, we look at every day the buyer is either gaining or losing, and the seller is gaining or losing. So money is always fluctuating. That's why we have initial margins and maintenance margins. If you remember that. And we said, so now how do we price and value that? Because like I've said, it's different from the forward contract. Now remember we said for this one, at every change in price, something is happening in the market. So if a price has gone up, somebody has gained and somebody has lost, based on if it's a call or a put, if it's the buyer and the seller. So the buyer is gaining money while the seller is losing, and vice versa. And at any point where anybody's money drops below the maintenance margin, which we have said is the minimum balance, we call it the minimum balance you should have. At any point where anybody's funds has dropped below that, that person will get a margin call, meaning you will be called to come and bring in additional money into the contract. And this additional money means that you will need to take your money up, and your money needs to go up to the initial margin, not just to the minimum balance. So if, like we said, if the minimum balance is 5,000 and they do the calculation and they discover that the money you have today, based on the movement in the market, your money has dropped to 4,005. You will be called, you get a margin call, you'll be called to come and top up that money. Now you are not just topping up 500 to take it to 5,000. No, you are topping up to take it to the initial margin. So let's say the initial margin was 6,000. Means you need to bring 1,005 to take you back to the initial margin. Okay? All right. So while the price of a forward contract is constant over its life, we discussed this as well, all through the life until the maturity. When no mark-to-market gains are paid, blah, 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 its value will fluctuate with changes in the value of the underlying. The payment and settlement of the forward reflects the difference between the forward price and the spot price from the underlying. They are just speaking the same English, which is, we have agreed at the beginning that we are going to do a transaction. That's for a forward contract. All through the life of the contract, the price will remain the same. The value will just, of course, be fluctuating as the value of the underlying is going on. Then at the end of the contract, we will pay ourselves based on the difference between the forward and the spot. So one person will gain, one person will lose. But for a futures contract, the price and the value both change when daily mark-to-market gains are settled. So this one, the price and the value is changing together. So consider a futures contract of 100 ounces of gold at 1,870, purchased on day 0. The following illustrates the changes in contract price and value with daily mark-to-market. So from day 0, the price is 1,870, which we have said. So at this point, contract is just starting. But from day 1, the price has moved from 1,870 to 1,875. So it means that there is a gain of 5. Right? So because of this gain of 5, when you multiply the 5 by the 100, which is the quantity or the contract size, remember, it gives you a 500. So the buyer has gained 500 and the seller has lost 500. Let's just assume in this case that it's that kind of contract. So because of that, you have the mark-to-market value has grown by $500. There has been a gain on the price, but the value of the assets of the futures contract has grown by 500. So the value has grown 500. Now, the new futures price is now 1,875. Remember this fluctuation we said. This fluctuation is a fluctuation where the mark-to-market, the clearing house will be settling you on a daily basis, every day. So day one you get this, they settle the buyer, they settle the seller. Day two they settle the buyer, they settle the seller. Day three they say like that. So it keeps going. So at the end of day one, your new price is 1875 from the 1870. So your price has gone up by $5. Now day two, price has now gone down to 1855. So in this case again, there's a movement in price by of $20, sorry. Now what is the value? That $20 multiplied by that same 100. It means that the value has gone down by 2,000. And this is the new futures price. Now, for this first day, this day one, the buyer has gained 500, the seller has lost 500. Meaning the seller, if this 500 is less than the maintenance margin, the seller will get a call, a margin call to come and top up. And then vice versa. This day to 2,000. In this case, the buyer has lost 2,000. So the buyer will most likely get a call to come and top up this 2,000. Then remember there is a ceiling for futures contracts. We mentioned that so that you don't just incur losses that are just unbearable. Okay? So that's that. So for futures, the price and the forward keep changing. So this is the example of where the price is changing. 1870, 1875, 1875, 1855. And the value is also changing from 0 at start to 500, from 500 to minus 2,000. So for futures, price and value changes. For forward, price remains contract control, but value fluctuates, basically. Okay? Any questions for me? Is it clear? So I continue. So the changes in the future price to settlement price each day returns its value to 0. Prices of forward contracts for which mark-to-market gains and losses are settled daily will also be adjusted to the settlement price. All these ones are stories, but the concept is that concept I've explained to you guys. Okay? All right. Okay, so we have market reference rate. We spoke about this when we spoke about swaps, and we said when you move from a fixed rate to a fluctuating rate, there's a market reference rate. So all this is saying is, so interest rate futures contracts are available on many market reference rates. So if you want to do an interest rate future contract, we may view this as exchange traded equivalent to forward rate agreement. One key difference is that interest rate futures are quoted on a price basis. For a market reference rate from time A to time B, an interest rate future is stated as the sold. Just the formula you need to know for interest rate futures. But the main one that usually comes out are the ones we spoke about. Okay? So explain why forward and future prices differ. We've also spoken about this when we've spoken about the margins and how you have mark to market for futures, but you don't have for forward. That's basically the summary here. And we have said for the forward price, the price is constant. The price of the forward is constant, but the price of the future is changing. Basically what we just spoke about here in this example. Okay? So this as well, just using this formula, I don't want you to really bother yourself about this. Okay? So that's the main thing that you need to know for this futures contract, is that the price of course is changing, the value as well is changing, so they are both changing, which is what for a futures contract, price and value both change. That's what you need to understand. For a forward contract, the price is constant, but the value fluctuates with changes. So that's the key point you need to know. And then in terms of the calculation, we've already done it before. That calculation, the market calculation, how to relate it to how to relate it to an initial margin and how to relate it to a maintenance margin, basically. Okay, so swaps, like I said, is not really the major thing, but we'll just look at it. So the next one is pricing and valuation of interest rates and other swaps. So you see that each of these readings are just small things to get. So because, like I said, derivatives is not one of the big percentages in your exam. But of course, you still need to pass it at the end of the day to help your overall score. So that's why you see the readings are very small. 2 or 3 of these readings should actually be one reading in real sense. We just want it to look like, there are a lot of readings inside. Okay, so pricing and valuation of interest rates and other swaps. So describe how swap contracts are similar to different series of forward contracts. For this, you won't be asked to calculate. It's just an explanation. So let me just take the explanation first. So we said a swap contract is a contract where I'm paying an interest, for example, of a fixed percentage, let's say 6%. Let's say I have a fixed percentage fixed rate. I borrowed money from someone and I'm paying 6% interest every year. Now I said, okay, I want to get a swap. So what does that swap do for me? I go and meet somebody and I say, okay, I have a loan I'm paying like 6%, but I want to do a swap with you. What does that swap entail? I will give you this fixed rate loan of 6%, you will be paying it, and me, I will pay you a floating rate. So let's say the loan is 5 million. So what will my interest be? What's 6% of 5 million? Oh yeah. What? So I'll be paying 300k, let's say this per year. Just make it so. So my loan is there, 300k every year, I must be settling down because it's ideal just to drop your 300k. Now, and that's okay, I go to meet someone and I say, okay, I want a floating rate. What does this floating rate mean? It means that today this 6% will be 4%. Tomorrow it can be 7%, whichever the case. However, I'm doing this because I believe that this floating rate will be less than the 6%. But if I know that it's going to be more than 6%, then there is no need, let me just pay my 6% there. So I have to get this floating rate. Now, this floating rate is linked to a rate called market MRR, which is a reference rate. So just the same way now, our what's that? What is the monetary policy? We come out with a new, every month they come out with inflation rate, every month they come out with yes, MDR, thank you. So currently it's at what? 24. It was 22 last time. So what does that mean? It means that at this rate, just for example, so if I index anything to this rate, so for example, the banks that are giving out loans, banks will be giving loans at NPR plus their margin. So when it was 18%, they will give 18% plus, let's say their margin was 3%. They will now give you 21%. Now the rate has gone to 24, and they are maintaining their margins. They will give you 27%. So this increase of 6% is not their fault. Their margin has remained the same. It is as a result of the index or the reference rate they are using. So that's what we are trying to say here. So when you move from a fixed rate to a floating rate, you are moving to a rate that is indexed on something. So meaning in this case, you believe that this rate will move from maybe 4%, 5%, blah, blah, blah. So what happens if it goes to 4%? 4% of 5 million is what? 200K. It means that the person has gone into this swap contract with, and we give him 200K, he will give me 300K to settle my loan. So meaning he has lost what? 100K. So I have gained because I have moved from a fixed rate to a floating rate. And I have gained because the rate has come down. If the rate was 7%, 7% is what? 350K. It means that I will still carry my 300K and go and pay my loan gradually. Then I will now pay this extra 50K to this guy. So I'm spending more here compared to if I was paying a fixed rate. So that's where the swap is. That's what we mean by swap. So I'm going into this. You will ask, why am I going into this? I'm going into this because I believe that rates will come down. That's why I'm going into this. Rates will come down and I will take advantage of it. So that's basically what this story is all talking about. It can be used for both. So for mainly short term. So you have 90 days, 180 days, 270 days, like that. Based on that, this can be used for that. Okay. So all this is just to say the same thing we have said. So you have 90 days, 180 days, 270 days, like that. So at the end of the day, remember that these movements are happening. So if it's a 90-day contract, there will only be movement at the end of the contract period. So this is a bit similar to the forward contract, because during the lifetime, we are not doing anything. We'll just wait for what is the interest at this point, and then we use that to transact. That's basically what this is saying. Okay? So therefore, we can describe an interest rate swap as equivalent to a series of forward contracts. So the swap is, let's say you have 4 swaps, 90-day, 180, 270, and 360. Between day 1 and day 90, nothing is happening. But in day 90, I will ask what's the percentage. Settle me, I settle you. That is similar this to the forward contract, if you remember. But in this case, because of swaps, there are probably different periods. So you have a 90-day or you have a 180-day. So that's why I said interest rate swap is equivalent to a series of forward contracts. So it's like you are doing 4 different forward contracts, but it's called a swap contract. However, there is one important difference. Because these forward contract rates are all equal, FRA. This will not be zero value forward contract administration. So recall that forward contracts are based on contract rates for which the value of the forward at initiation is 0. We keep mentioning this. You have to know that it's very important. There is no reason to suspect that the swap fixed rate results in a 0 value forward contract for each of the future needs. Instead, the swap is most likely to consist of some forwards with positive values and some forwards with negative values. The sum of the values will equal 0 at initiation. So whether it's swap, whether it's forward, at the end of the day, at initiation, everything boils down to the 0. Okay? Finding the swap fixed rate that gives the swap a 0 value at initiation is what is known as the par swap rate. So I don't want to, let's just, okay. Now, contrast in value and price of swaps. So you see how we are moving from, everything we are talking about is value and price. We started with value and price for forward. We moved to value and price for futures. Now we're in value and price for swaps. Now, as with forward contract, the price of a swap is the fixed rate of interest specified in the swap contract, and the value depends on how expected future floating rate changes over time. As an illustration, a swap has zero value. This is similar to a forward contract, like you said. Forward contract as well has zero value because the present value of the fixed rate payment equals the present value of the expected floating rate. So you don't need to solve this, but what this is just trying to prove is that the reference rate for each year should be equal to the forward rate discounted. You don't need to calculate this, but that's just what this is trying to say. Still trying to prove that value and price are similar to the forward contract. Okay? Don't want to bore you with all the calculation. So, an increase in expected future 90 days rate will produce an increase in the value of the fixed rate payer position in the swap, while a decrease is expected to decrease, vice versa. At any point in time, the value of the fixed rate payer side of the swap will be the present value of the expected future floating payment minus the present value of the future fixed rate. Calculation is based on spot rates over time and can be used to require. So, leave all the stories. The price and the value for the swaps are similar to the forward rates. That's what you need to know. So we mentioned three things now. We mentioned price and forward, and we mentioned over time. We mentioned futures, and we said, okay, for the futures, the price changes, the value changes every time. For forward, it's different. It remains the same until the end of the contract. Same for swaps. So the summary is the price of a swap, the fixed rate specified in the swap contract. The value depends on how blah 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 increase. All these stories are not. I don't want them to confuse you guys. So that's the point. The point is the price and the value for each of these different types of derivatives are what you need to know, basically. Okay? So that's for swaps. So of course we go to options as well. And of course for options we still talk about the price and the value as well. Now we've spoken about some of these things in options. So we said moneyness. This moneyness we spoke about in the money, out of the money, or at the money. And what did we say? We remember our example of call and put option. So let's take the call option. If the option is favorable to me, it means it is in the money for me. The money means I'm gaining money. If I am not losing anything, it means I am at the money. But if it is out of the money, means that if I go ahead with this option, I will lose money. And of course, like we have said, it's an option. Therefore, I am not going to lose money. So what would I do? I will not exercise it. So it means that you can note it. Any option that is in the money will be exercised. Any option out of the money will not be exercised. So those are the two main ones that you will get in the exam. Okay? So let me just run through this, but it's something we've spoken about already. Moneyness refers to whether an option is in the money or out of the money. If immediate exercise of the option will generate a positive payoff, it is in the money. If immediate exercise will generate a loss or negative payoff, it is out of the money. When the current asset price equals the exercise price, exercise will generate either a gain or loss at the money. What about it? The following describes the conditions of call option, blah blah blah. Remember we said S is today's price, X is the agreed price. So in the money option, it's saying if today's price is greater than our agreed price, the call option is in the money. So it means that this is the amount of payoff the call holder will receive from immediate exercise. What does that mean? Remember, the call option is to buy. I have said I'm going to buy this derivative at a particular price. Now the price today is greater than the price I agreed to. So it means I'm not going to exercise the option. I would prefer to go ahead with the price today. Go ahead with the price we have agreed. Because I can buy it cheaper from you than I can buy it from the market. So that's what this is saying. And then out of the money is the same thing. So it's just giving it an English, an English name for what we have said, moneyness. We've spoken about this before. And then the opposite works for a put option. We said the put option is the option to sell. So if I can sell something at a higher price in the market compared to what we have agreed, of course I will go with the market. But if the price I've agreed with you is greater than the market, then I will go with the price I've agreed with you. So the first one says if the money put option, meaning X, which is agreed price, the price I agreed with you is greater than the price in the market. Now I am selling as a put option. So I'll be very happy. What am I going to do? So I'm very good. This means that I can go ahead with this option. It makes sense for me to go ahead because I will make money. So that's the money. Out of the money is the opposite, and then as the money is, I'm not gaining, I'm not losing. So the question says there is a call. The call price we have agreed is $14. But now it is currently selling at 37. What does this mean again? I have agreed to buy something at $40, but in the market, today's price sold at 37. Will I go ahead with the option or not? I will not go ahead with the option. I will not exercise the option because I am out of it. Make me to be out of the money. Because I can say, okay, I'm not doing it again. Let me go and buy it at $37. So meaning this option will lead to an out of the money for the call option. Then we swap it for the put option. Put option I am selling, and I have agreed to sell at $40. But in the market, this same product is sold at 37. It means for the put option, I will honor the option and I will exercise it. Meaning I will gain $3. Meaning I'm in the money for the put. So that's what it's saying. So that's the same answer here. The call is out of the money, while the put is in the money. As simple as that. Any question so far? Alright, so that's that. So it's basically the same things we've spoken about before. We're just bringing it again from a different angle. Now, we define the exercise price of an option as the maximum of 0 and the amount that the option is in the money. That is, the exercise value is the amount an option is in the money. If it is in the money or 0, if the option is at or out of the money, the exercise value is the value of the option if exercised immediately. So let me explain this in all the English. Okay. So let's take examples now. So we have a call option. So let me do all the options. Okay? So for the call option, let's assume that we have the X, which is our agreed price, let's assume is $50. And then let's assume this one is $47. With this, am I exercising the call option or not? We will not. Very good. I will not exercise the call option because X is greater than S, meaning that I can go to the market and buy this product at $47 instead of going ahead with my option. So in your note, you'll be seeing X minus S greater than 0. So meaning that if this is negative, in this case now, S minus X. In this case, it is negative. That's 47 minus 50 is minus 3. Minus 3 is less than 0. So, not exercise. So I will not exercise, right? So it means that in this option, this 47. So remember, I'm not exercising. It's a two-way. So because I'm not exercising this, so let's take another example now. X remains 50. So I can't change. But now our S is 45. Right? S is 45, meaning that same thing, 45 minus 50 is what? Minus 5. So not exercise. Right? So as long as this the underlying price or the price today keeps going down, I will not exercise. So let's take the example the other way around. So let's say our spot price is now 52. Because of this, so I use the same formula. 52 minus 50 is 2. 2 is greater than 0, so I will what? Exercise. Meaning that I can buy this stock at $50 compared to buying it at $52. But now, so this is, let's call this scenario 1. This is scenario 2. In scenario 1, this 45 will just be going down. The maximum this 45 can go down to is 0. Right? Because this price will be going down. So, of course, I'm not exercising, but it will be going down, But for this one, there is no maximum here because this price can go up to 1,000. So, meaning the benefits I will get here from exercising can keep going up till infinity. So, meaning that in this case, as long as this, for a call option, as long as the benefit I can get is basically unlimited, because this one will be can be going up and I'll be making money as a benefit. But yeah, the other way, I'm not exercising, so it will just be going down to 0. So same example for this guy as well. So let's flip it. So let's make this 60 and let's make this 55. So a put option means that I want to sell. So I'm agreed to sell at $60. But now the price of the item is 55. Therefore, I will exercise. I will exercise because X minus S is greater than 0. Meaning 60 minus 55 is greater than 0. So I will exercise. It's important you note this, or this thing I'm doing here is very important for you to understand options and pricing and valuation. Okay, so let's take our scenario 1, just like we did here, and then let's reduce this. So this will now go to 51. So if I reduce this, say S minus S, let me just do it, 60 minus 51 is 9, which is greater than 0. So I will exercise because the price that I agreed is greater. Second option. Okay, before I go to the second option, let's look at it. So in this first option, what is the maximum thing that can happen? So I'm exercising because my X price is greater than this. So the maximum thing that can happen here is this one. Let me do the second one so that we see. So if I take it up to 62, now 60 minus 62 is minus 2, which is less than 0. So I will not exercise. Good. So in this case, this first example, the maximum benefit that this put option can get is 60. Because you know it's only going to exercise because its agreed price is greater than 8. So if this agreed price becomes 60, it's at the money. So the maximum here is that 60. So the moment it crosses to 61 or 62, it flips, it will no longer exercise it again. So what point am I trying to bring out? I'm trying to say at this point, for the call option, there is a maximum, there is no maximum gain here for the call holder because the underlying price will just be going up. This can go up to 1,000. What concerns it? We will be exercising 1,000 minus 50. We will be exercising. We keep exercising and exercising because it is positive for you. But for the put option, the maximum it has here is this agreed price. That's why I tried to show you this. Is this agreed price? Because anything more than this 60, it goes into a loss. Okay? Is that example clear? Yeah. So we define the exercise value of an option as a maximum of 0 and the amount that the option is in the money. So all this story is still trying to say what we are talking about. Prior to expiration, an option has time value in addition to its exercise value. The time value of an option is the amount by which the option premium exceeds the exercise value and is sometimes called speculative value of option. This relationship can be written as this, so don't worry yourself about it. What it's just trying to say is that there is a value of the option as time is going on. That's the time value. Now, at any point during the life of the option, its value will typically be greater than its exercise value. So meaning, what it's trying to say is that the value of this option changes. That's the summary of what you need to know. The value of an option changes. Recall that the option's exercise value is the amount of pay of an expiration and has a lower bound of 0. When the option reaches expiration, there is no time remaining and the time value is 0. This means the value at expiration is either 0 if the option is at or out of the money, or if the exercise value is in the money. What is it trying to say? If the value at the end of the option is that value I've gained, if it is in the money, I've gained value. If it is out of the money, I can't lose value, so it's 0 to me. Remember, you cannot lose with an option. I can't get a negative value because it is a right, it's not an obligation. I can choose to walk away. So what we say is the value will be 0 if I am not making money or I am at the money. At the money, I'm not gaining, I'm not losing. So it will be 0 or it will be in the money. That's what the value is. That's what it's trying to say. Okay? And of course, the price is the one that will be changing. As the asset price is changing, the price will be changing as well. So that's price and value that we've spoken about. So the next is we've spoken about arbitrage. So contracts the use of arbitrage and replication concepts in pricing forward commitments and contingent claims. So now, following some terminology that we use to determine the minimum and maximum values of European options. So we have European options and we have American options. So the European option is the one that stays till the expiry date. The American option is the one that can be that can expire at any time of the life of the contract. Okay. So we've spoken about some of these concepts. S is the price of the underlying, X is exercise, T minus T is the time to expiration, the CT is the European core at time T, PT is the quote at time T, then the risk-free rate, RF. So this one now is some of what I've explained to you in that box, which is why I said it's very important to understand that concept. That's what they want to talk about. What is the upper band for a call option? So the maximum value for a call option at any time is the share price of the underlying stock, which is what we spoke about in our option 2. Where we said there is no maximum because it is the share price. So if the share price keeps going, that S, if S keeps going up, that's the value, and that's how much it will be going up. So that's what this has said here. The maximum value of an European call option at time T is the share price of the underlying stock. So if we look at the price today, it is the share price as at today. So if the share price keeps going up, that's the highest band. This makes sense because no one will pay more for the right to buy an asset than the asset market value, which we have said. It will be cheaper simply to buy the asset. So at time T, the upper boundary condition for European is SO at any time of the call option. Right? So that's basically what we have said. The upper band for a call option is the stock price. So as stock price is going up, it is going up. Okay? Now for put option, we look at the put option as well. Now logically, the value of a put option cannot be more than its exercise price. This would be its exercise value if the underlying stock price goes to 0. However, because European puts cannot be exercised prior to expiration, their maximum value is the present value of the exercise price, discounted at the risk-free rate. Even if the stock price goes to 0 and declared to stay at 0, the put buyer will not receive the X until the expiration date. What is it trying to say? All the story. We have said that if you look at our put option, the one is going to exercise, we said the maximum benefit, that's option 1, the maximum benefit that the put option will get is the exercise price. So option 2 and option 1 are the ones we really need to know. So the maximum here is exercise. So this and this are what we need to know. So maximum for call is the strike price. Maximum for the other one is the exercise price. Okay. Now, upper bound for put option. So this is the one we're talking about. So that's the one I've just explained now. So at the end of the day, still don't worry about the formulas, but that's what you need to know. Lower bands for options, which is what we have spoken about with number 1 for call and number 2 for put option. So theoretically, no option will sell for less than its intrinsic value, and no option can take on negative value. So all this one you see not exercise, not exercise. If you like, the price will be going down, doesn't matter. As far as it is negative, the option is out of the money. So for European options, however, lower band is not so obvious because these options are not exercisable immediately. To determine the lower band for European options, you can examine the value of a portfolio in which the option is combined with a long or a short position, a stock, and a pure discount bond. So what this one is trying to say is just to bring a completely different angle to it. Say you want to look at, let me explain. So you are now saying you want to determine the lower band for an option. So you want to examine the value of the portfolio and you want to combine two things. You want to option is combined with a long or short position in the stock and a pure discount bond. So you see you want to have an option on the left hand side and you want to have the stock position and a discount bond. Remember we said for no arbitrary position to exist, everything must lead to the same price. I must have the same price at the end of the day when I take this side and I take the other side. So for an European call option, construct the following portfolio. A long at the money European call option with exercise price X expiring at time T. Don't worry, you don't need to know this calculation. A long discount bond price to yield risk-free rate that pays X, and a short position in the share of the underlying stock. So this is basically the formula. So the point is to prevent arbitrage. Any portfolio that has no possibility of negative payoff cannot have a negative value. So we state the value as this. So this is what we need to, the formula we need to know is the call option is greater than or equal to the spot price minus the exercise price at the risk-free rate. So all this you don't need to, I'm sure there's a place where they said you don't need to calculate all these things. So I don't like to bother you guys with it. So for the exam, just need to know the price limits. You will not be asked to calculate them. So this is just what you need to know. So the call option is greater than, so these four things is what we have both spoken about. So for the maximum value of the call option, we said it is the price, which is number 2. The minimum value, of course, we said as far as the call option still has value, we will exercise it. So as far as the call option is greater than 0, we will exercise it. All these ones are just stories, right? As far as the call option is greater than 0, you will exercise it. Now we go to the put option. It's the same thing. We said the maximum value for the put option is the exercise price. But in this case, the exercise price has to be discounted. That's the only difference. The exercise price has to be discounted using the risk-free rate. That's the only difference between this one and this one. Then of course, the minimum value for the put, it has to be more than 0. That's all. So that's what you need to know here. I've explained these two already. These two doesn't need explanation as far as it's less than 0. As far as it's greater than 0, sorry. These two we've explained the concept. So that table are put by the right, or that those calculations 1, 2, 1, that's what you need to know to help you understand what it is that we are doing. Okay. Now, identify the factors that determine the value of an option and describe how each factor affects the value of an option. So there are 6 factors. The first one is the price of the assets. We basically spoken about this one as well. So as the price is going up for the call option, the call option value is also going up, which is this maximum number 2 option. So for call options, the higher the price of the underlying, the greater its exercise value, and the higher the value of the option, then vice versa. So the second one is the exercise price. And the higher exercise price increases the value of the call option, and the lower exercise price increases the value of the call option. It's just the same story we have said. Now the risk-free rate. Remember, this risk-free rate is what we have in those formulas to calculate in relation to today. So an increase in the risk-free rate will increase call option value, and a decrease in risk-free rate will decrease call option value. So I just need you to understand it, because at the end of the day, you are bringing it to present value. So is that rate at which you are bringing it to present value? Okay. So one way to remember the effects of changes in risk-free rate is to think about the present value of payments for calls and puts. These statements are strictly true only for in-the-money options, but it's a way to remember the relationship. The holder of the call option will pay in future to exercise the call option, and the present value of that payment is lower when the risk-free rate is higher. So a higher risk-free rate increases the call option value. So because you are going to pay for this call option, and this risk-free rate is going to be used to discount the present value. So the higher the risk-free rate, the higher the call option. Then volatility of the underlying. So if there are volatilities, makes the option valuable. So an increase in the volatility increases both put and call options. Then time to expiration. So of course, the longer time to expire, the more possibility that there will be more volatility. So your time to expiration can be linked to volatility. So longer time increases value of call option. Longer time increases value of put option as well. Okay. Then cost and benefit of holding the assets. We've spoken about this as well. And we said if there are costs, you add it back. If there are benefits, you deduct it. So of course, if you are adding back, if you are deducting benefits, it means that the value is reducing for a call option. Then the opposite for the put option, basically. Okay. So I will just move. Any questions so far? This is basically the summary of what we have said. So I think this is what you need to note. Majority of the movements are different. So what happens in call, the opposite happens in put, except for volatility and time. Because we said as there is more volatility, there is belief that prices can get better. So that increases the value of the call or the put option. And then of course, if there is volatility, there is time. So as much as time is changing, there is possibility that there will be volatility. So those are the only two where you have similarities between call and put. The rest are opposites. Okay. All right. So now we now look at the option replication using put call parity. So we need to explain what put call parity is first for European options. Okay. So remember we have spoken about X and S, X and S. So we need to understand that. So at the end of the day, if you remember, we have call option. This number 2 scenario for call option and number 1 scenario of put option. For number 2 scenario of call option, imagine there is a call option and the seller of the call option does not have anything to help himself. It means he can lose so much because the buyer will gain. There's no limit to what the buyer can gain as far as the share price is going up. For the put option, there is a limit because the limit is the agreed price, which is the X. So how do the seller and the buyer try to hedge themselves? That's one of the things we're going to talk about. Okay? So a fiduciary call is a combination of a call with exercise price X and a pure discount with a riskless bond that pays X at maturity. The payoff for the fiduciary call at expiration is X when the call is out of the money, and X plus X minus S is equals to X when the call is in the money. We'll talk about this further as well. A protection put is a share of a stock together with a put option on the stock. The expiration date payoff for the protective put is X minus S plus X, which is X when the put is in the money, and S when the put is out of the money. So let me explain. So if at expiration S is greater than or equal to X, right? At the end of the day, let's say for let's look at the put. We're using S to say at the end of expiration, we discover that the price of, so this S is greater than X, which is this for the call option, scenario 2. And then it's just like this. So for the call option, right, when S is greater than X, just follow me on. For the call option, we said what happened. You will exercise, right? And we said there is no maximum for the buyer. Or we just say the maximum is equal to S. For the put option, this same scenario, you will do what? Not exercise. Okay. Now, so if at expiration S is greater than or equal to X, these are the two things you will do. But now let's relate it to these new things we've looked at. So, a protective put pays S on the stock, while the put expires worthless. So the payoff is S. What does that mean? So for this put, right? So now I already have an option. I'm not bringing something on top of that option. So for this put, if this is greater than this, I will not exercise, meaning that the option is worthless. It's out of the money, right? So it's 0. But because I want to hedge against this, I will now put a protective put to protect this put. Now that protective put means that I'm going to go and buy this stock. Follow me. So for this put, I'm going to come. So the protective put is to buy the stock. Right? So I have two things now. I have two things. I have a normal put, then I have bought the stock. So in this first scenario now, I'm not exercising, meaning I have 0. But because I have bought this stock before, right, I can now sell this stock and I will get this price. You get it? So that's what the protecting put is. I'm protecting myself on this. Meaning, so there are two options. Option 1, this happens. Meaning that I do not exercise, I've lost on the option. But now because I've bought the assets from the other end, I've gained. So I'm hedging myself from different directions. So I've gained, I can sell the stock and gain the stock price. The other way around. So the protected put pays S on the stock, which is this one. While put pays is, so the payoff is S plus this, which is basically. Sorry, while looking at the one on top. So the payoff protected put will put pays S, which is this. While the put expired on death, so the payoff is S. Now, this same scenario, I have this protected put, but now S is greater than S. So what happens to my put? I will exercise, right? Which is this one. The protected put pays, I will exercise, and then of course I will sell my protected put. Which is what they are saying here. The protected put pays S on the stock, while the put pays X minus S. So the payoff is back to X. Let me use numbers. So let's assume that this S is 50 greater than, and this one is 40. 50 is greater than 40, right? Meaning, for the put option, I agree to sell at 40, but that is being sold at 50 in the market. So for this case, what am I going to do? I will do exercise. Then I will go and sell the market. Since I bought this stock, I will now sell the stock at 50. So my gain here for this one is the stock price, 50. Because my put is worthless. Now we flip it the other way. This is X minus S. This is what? So X is greater. So we have 60 here minus 45. So I will exercise. 60 minus 45 is what? See. So I have 15 benefits here. Then remember I bought it 30 put. What does that mean? I already bought a stock. I bought the stock at 45. So I will sell the stock at 45. So now I have 45 plus 15 again here, which is what? 60, which takes me back to my first. So that's basically what it's saying. So for the put, your answer would either be S or X. It will be S when you are not exercising, and it will be X when you are exercising. As simple as that. Now, let me explain the call. Basically the same concept. Now, for the call, it's just basically the opposite. So for the call, which is this same scenario, S is greater than X. Now, for the call, am I going to exercise or not? My wife is part of it. So this one was the put. So for the call now, S is greater than S. I said I'm going to buy 50 greater than 40. I said I'm going to buy something at 40 naira, and the market is 50 naira. So what am I going to do? I will exercise. So yes, so call exercise. So because I'm exercising, means I will now have what? 50 minus 40, which is 10, right? Now, for the fiduciary call pays X on the bond portion, while the call pays X minus X. So the payoff is so same concept at the end of the day. So I've already bought the bond option, which now gives me the 40. I bought a bond based on this price, the exercise price, right? So my bond now, I will sell my bond at 40, right? 40 plus 10 is what? 50. So I'm back to S. That's what this is saying. Fiduciary call pays X on the bond, which is this 40, while the call pays the 10, which is this 50. Now, the other way around, X is now greater than S. So let's say 65 and 45. So what do I do here? Will I exercise? No, not exercise. So because I will not exercise here, so what now happens? Remember, I have a bond that I bought at what? 40. So of course again I'll sell my bond at 40. So the total money I have is 40, which is equal to 40. So the exercise price is greater than the spot price. So the bond here is 65. Remember, that's the X. So meaning that I will sell the bond, meaning that my payoff is the same as X. So you see it's the same thing. SX, SX. It's just different. So I think it's just note it as a summary on your note. When the when S is greater than X, so for a call option, that means it is in the morning. Therefore you will exercise. It is in the morning, therefore you will exercise. Okay? The payoff is therefore equal to F, the underlying price. Right? So, still on that line. For the tools, it's vice versa. Okay? And then when the exercise price is greater than the underlying price, the call will not be exercised. And it will be equal to the exercise price. So meaning that the rotating put is equal to the fiduciary call. So if you look at it here, our first example, when S is greater than X, our payoff was S. When S is greater than X, our payoff was X. When X is greater than X, payoff is X, and vice versa. So that's what you need. So if you just want to understand, you can pick the one that is easier for you to understand. So if it's the put you know it's easy for you to understand. Just understand that one and know that however the put ends, it's the same way the fiduciary call will end. And vice versa. We just need to understand what. Remember, at the end of the day, we are trying to hedge ourselves against what we feel the option will be. So this is like an additional option on top of the option. Okay, any question? Okay. So in either case, the payoff of protecting puts is the same as the payoff of fiduciary call. We just said that. No arbitrage condition holds that portfolio with identical payoffs. So that's just basically what. So your call and your puts are the same. It ends up at the same payoff. So what you need to do is you need to understand this calculation and see how. So I think at the end of the day, when you can just, it's very easy to say we are different because what you call when you don't exercise, it goes to the exercise price. But when you put when you do exercise, it goes to the line price, so they are a bit different. Okay? So in other words, this means that the payoff on a long stock can be synthetically created. With a long call, a short put, and a long position in a risk-free discount bond. All this was what that means is, remember you are trying to balance it. We have said protective put is equal to fiduciary call. Now, the protective put is the put and the stock. Right? You are buying the put and you are buying the stock. For the call, you are buying the call and you are buying the call. So that's the relationship between them. So what this is trying to say is that this means that the payoff on a long stock. So if you have a stock, you have the stock. You know there are 4 things now. You have the stock. So you can use this stock to calculate what puts you need and what call you need that will give you an equilibrium, basically. So that's why they can be created with a long call, a short put, and a long position in a risk-free discount company. Okay? So this is an example of that relationship. So you have, this all that relationship kind of explained in this formula. So this is the call. So remember this part. This is the put and the stop. This second part, S plus B, is the put and the stop. And then the left part is the call and the bond, basically. So you can reshape the formula any way you want to reshape it. So if, for example, I have S, I don't have P, I can move S to the other side of the equation and calculate sum for P. That's basically what this is saying, which is also what they have tried to do here at the end of the day. Okay? So suppose that the current stock price is 52 and the risk-free rate is 5%. You have found a quote for a 3-month put option with an exercise price of 50. The put price is 1.5, but due to light trading in the call options, there was not a listed quote for 3 months. For the 3-month $50 call, estimate the price of the 3-month call option. So in this question, we are asked to calculate the call option, but we are only given the call option, but we are only giving put and the other. Let me take it again. Remember in this our calculation now, we said a fiduciary call is equal to what? A protected put. Right? We said they are the same. And what is a fiduciary call? Fiduciary call is a call plus a bond. A pure discount bond of the bond. And a protected put is a put plus the shares. Right? So we now said the call, the formula for the call is C. The bond is 1 plus RF used to power T. The put is the put and then the share price. Yeah, so the call, so the bond is the call plus exercise price. So C plus this used to power T is equals to S plus P of Q. Right? So this is the formula we have been given. So let's look at the question. The question says, suppose that the current stock price is 52. We're given a stock price, which is this, 52. And the risk-free rate is 5%. So we'll come here and do this. You have found a quote for a 3-month put option with an exercise price of 50. So our exercise price is 50. So 50 times 1 plus, what's our risk-free rate? 5%. Raised to power minus 3 over 12. And what's our call? The put price is 1.5. They're giving us put price 1.5. So what we need is this call, right? So of course, to make this call the subject of formula, it's basically to carry this guy to the other side, which is what they have done. So C is equal to P plus S minus S 1 plus R by raised by minus 2. Okay, so you have your 1.5 plus 52 minus 50 times 1.05 raised to power 3 over 12 plus 0.25. So that's what they have done here basically. That's the 1.5, that's the 52, and then you have your 50, because it's minus, that's why they have just done 50 divided by 1.05. Because of the minus, so you need to reverse it. So that's how they got 4.11. So this means that if in 3 months $50 call is available, it should be priced at 4.11 per share. So that, because we said everything must be equal. So this now means, so this one now is what we have calculated here, giving the options. It's possible that the question could have come from what calculate P. So let's assume we didn't have plus 1.5. If we didn't have 1.5, this formula would have been P is equals to call plus bond minus share. Meaning our call is plus 4.11 plus the bond, which is 50 over 1.05 raised to power minus 3.5 minus share 52. This should give us our put of 1.5. Can you calculate this? Okay. Okay. So, explain put call forward parity for European options. We just did the put call. We just did the one for. We just explain put call parity. So, this one now is the forward parity for this. So, put call forward parity is derived from the forward contract rather than the underlying assets itself. So that means that instead of having the asset, the share as S, you now have forward price. You now have forward price. So that's the difference. So you see here you have the 1 plus RF, you have the PO, you have the CO. Okay, so this is the call. We still have the call. We still have the bond. Are you with me? We still have the call plus the bond, which is the fiduciary call, right? Then on the other side, which is the side where we're supposed to have the protective put, which is the put and the share price. We still have the put, but now the share price, which is the underlying, has been replaced by a forward contract, a forward price, right? So this forward price, this is now the formula for the forward price, because of course the forward price has to be discounted to present value, right? So the same thing you have, you know, this one we have to discount this to present value. That's why we do 1 plus RF. So now we are bringing in a forward. So the only thing this forward is doing, so same formula you used before. The only difference is that now instead of share, you now have forward. But that forward has to be discounted because it is not current price. It has to be discounted to present value. So you have FO T1 plus RF minus T. So which is put call forward parity at time 0. So same story. So everything is the same. The only difference is just that instead of our share price there, we have now switched to forward price, and that forward price has to be discounted. So this T is the time. So the forward price at the time times 1 plus RF raised to power minus T. So this side is equal to the bond. The only difference now is that you have just added the forward price, that's all. So that's what you have called the put call forward parity. That's the only difference. And of course, you rearrange the formula to get the puts, to get the call, depending on what the question asks you for. Okay? So that's that. I don't want to bore us with that. Okay, so this first question says the put call parity relationship for European options must hold because a protective put will have the same payoff as fiduciary call. Then the put call forward parity relationship, this likely includes what? This is the one we just did now. Risk-free bond, call and put option, and then underlying assets. So the answer is underlying asset because we have replaced the underlying assets with the forward. So as simple as that. Okay. Any questions? We are in our last or second to last reading, in fact. All right. So this one is easy, but you just need to understand the concept. So if you remember concept of decision tree, for those that need some of those courses in school. So this is just looking at decision tree. You have, remember you said there are options, right? But now this option is now, we are valuing it using a concept. Don't worry about the big English. Binomial, don't worry about it. It's very easy to learn. Okay? So explain how to value a derivative using a one period model. So I don't know if you guys have done it in quantitative methods, but let's just continue. So to construct a one period model for pricing an option, we need one, the value of the underlying at the beginning of the period, the exercise price, returns that will result from up and down movements, and then risk-free rates. So all this is that basically things that we know. For now, we do not need to consider the probabilities of an up and down. So let's use an example. We can model a call option with an exercise price of $55 on the stock that is currently valued at $50. Let us assume that in one period, the stock value will increase to $60. So if the stock value increases to $60, is this option in the money or out of the money? It's in the money because I can buy at 55 something that is sold at $60. Very good. So we state the return from an up move as this and a down move as this. So what does that mean? So now we are putting a bit of numbers to what we are talking about. So okay. So we said the exercise price is $55, right? And we said the price of the asset, which is S, is $50. Right. So in period one, year one, two things can happen. That's why we call it decision tree. Decision tree means that A can happen, B can happen. So this binomial model is trying to calculate what are the benefits of each of the decisions. Decision 1 or decision 2. So firstly, option. So this is option on top of option. So let's call it scenario 1. Scenario 1, the asset has moved to 60. Right? The asset has moved to 60. And in scenario 2, the asset has dropped to 42. So in scenario 1, are we exercising or are we not exercising? Scenario 1, because the price in the market is now greater than the price we agreed, we would exercise. And then it's less, we will not exercise. Okay? So, this upward movement, this 60 and 42 now, in an example, you will not be given this 60, you will be given the upward movement. So what this is now saying is, today the stock price is 50. If you are given an upward movement of 1.2, how do they get that 1.2? They just get 60 to mark. So if you do 50 times 1.2, you will get 60. So in an exam, you will be given this 60. You will be given this 1.2, and then you will do 50 times 1.2 to give you 60. And then same as 0.84. Okay, so there is up, there is down. Up gives you 1.2, down gives you 0.84. And then the story begins, like I've said. The call option will be in the money after an up move or out of the money after a down move, which we know. This valuation is this, which we know. Positive of 5, and then down move is negative of 0. Now we can use a no arbitrage pricing to determine the initial value of the call option. We do this by creating a portfolio of the option and the underlying stock, such that the portfolio will have the same value following either up move or down move. For example, we write the call option and buy a number of shares of the stock that will denote as H. Must solve for H that results with blah blah blah. So what this is trying to say is, so the initial value of our portfolio is V, which is the stock minus the call. The portfolio value after an upward move is this. After a downward move is this. Now, in our example, you have 60 as the upward move and then 42 as the downward move. So at the end of the day, what is that H, which we have said before that we are going to call that H, where is it? For example, we'll call that H the number of shares to buy. So what number of shares will you buy to ensure that at the end of the day you balance it out to hedge your risk? So this result, the number of this 0.278 based on this formula is the number of shares we will buy for each call option, which is known as the hedge ratio for the option. Yeah, so that's basically that. What you need to know is this risk neutrality, because that's where the real calculation is. So in this up and down that we did here, this up and down that we did, we did not put any risk. What is the probability of one occurring or the other not occurring? We didn't talk about that. That's where this risk neutrality comes into play. So another approach is to construct this involving risk neutrality of an up and down. So consider a share stock valued at $30. The size of the possible price changes and the probabilities are this. The RU is 1.15. Therefore, the down is 1 divided by 1.15. So it's an inverse relationship at the end of the day, right? So you have, once they give you up or down, you know that the inverse of the up is the down and the inverse of the down is the up, basically. So this is the down move factor, 0.87. Risk neutrality of an up move is 0.715. Risk neutrality of a down move is 1 minus 0.715. Because the risk neutrality must give you 100%. So one is 71% or 72, the other is 29%. So now, if I'm going to draw that graph again, we are starting at 30 today, right? So at this point, I now have 30 times 1.15. What do we have? Well, 30 times 1.15. What do we have? Then you now have 30 times 0.87. What do you have? So 30 times 1.15 is what? Yeah. Okay. So 30 times 1.15, 34.5, and then this one is 26.1. So you see that one is going up, one is coming down. Now, this is before we bring in the risk factor.
Now, so this is the calculation. So this is 34.5 and then 26.7. Now, you now have a risk factor. Before we get to the risk factor. So you will be giving, so this calculation I've done is this. You will be given a stock price, which is the beginning value. And then you'll be given two possible values, which is the 1.15 and the 0.87 that we just did. Now, we'll still come back to the risk probability. Now, the risk neutral probability of an up move and a down move are calculated from the sizes of the moves and the risk-free rate. So you don't need to know this calculation. What you just need to know is the decision tree. So let me just go to this example. So using this to calculate the value today of a 1-year call option on a stock with exercise price of 30, assuming risk-free rate is 7%, the current value of the stock is 30, and the up factor is 1.15. So if you have the up factor as 1.15, you need to calculate the down factor. So of course, we said the down factor is the inverse of that. So 1 over 1.15 gives us the 0.87, which we have used in our calculation. But now, the risk neutral probability, how do we calculate it? So that is 1 plus the risk-free rate minus the down probability divided by the up minus the down, which is this formula we have here. Risk neutral probability of an up move. So you will calculate the up move, and then 1 minus what you get will give you the down move. So that's what they've done here, 0.715, 0.25. Now, let's determine the payoff in each state. If the stock moves up to 34.5, a call option with an exercise price of 30 will pay this. If the stock moves down, the option is worthless. So that's what this is saying. The expected value in one period is this. So when the call moves up, there's a value. When it comes down, there's no value. But now, what is the value of the option today? That's where we now bring up this probability. So I can continue my formula. So I've got it. So if it goes up, it's 34.5. If it comes down, it's 26.1. Now, if it goes up, we have said that we will do what? We will exercise. And if I exercise it, it will be 34.5. So if I exercise this, it will be 34.5 minus 30, which is 4.5. Now, what's the probability that this 4.5 will occur? That's the 4.5 times 0.715. Now, for this one, am I exercising? No. So therefore, the value of this is 0. 0 times whatever the probability, which I don't really care, because this will give me 0. So my answer is basically 4.5 times this, which is 3.2. That's the answer for that. So it is the premium, it is the benefit you get that you use to multiply the probability. What is the probability that this benefit would occur? What is the probability that this benefit is going to occur? That's what we look at there. Okay, so the same way for a call, the same way for a put. So same scenario, it's just that it's now inverse. So the probability of the one that is a put is 0, then the other one is positive, and you get your 1.17. So in practice, we would construct a binomial model with many short periods and have many possible outcomes at expiration. However, the one period model is sufficient to illustrate the concept and method. Note that actual probabilities of an up move or the down move do not enter directly in our calculation of option value. The size of the up move and down move, along with the risk-free rate, determines the risk-neutral probabilities we use to calculate the expected payoff at option expiration. Remember, the risk-neutral probabilities come from constructing a hedge that creates a certain payoff because their calculation is based on arbitrage relationship. We can discount the expected payoff based on risk-neutral probabilities using the risk-free rate. So I take it again. You get the decision tree is clear. You'll be given a price today. You will be given the RU, which is the price, the size of an up move. You now need to calculate the size of the down move by doing an inverse of that up move. So 1 over the up move will give you the down move. So this one was 1.15. So 1 over 1.15 is 0.87. So 0.87 is the size of the down move. Now, to calculate the risk or the probability of this occurring is to say 1 plus the risk-free rate minus the down move divided by the up move minus the down move. That gives you a probability of an up move. Then you just do 1 minus that to give you a probability of a down move. And like we said, the probability must be equal to 100, so or 1. So if you add 0.715 and 0.285, it will give you 100%. So we use that to calculate our put value in 1 year, and then we just discounted it to today by dividing by the risk-free rate. So that's basically that for your binomial model. So you just need to understand the decision tree and how to calculate it. Okay, any questions? Okay, so we have officially come to the end of derivatives. So please remember all the concepts we spoke about. So you see, we dealt with a lot of options. So you need to be able to relate today's price and the agreed price, the S and the X, how it relates. Knowing the option is your right, it's not an application. You can decide to go ahead, you can decide not to go ahead. Just to understand those concepts, basically. Okay, so thank you guys very much and enjoy your week.